Introducing the 3-part options course with Hans Albrecht. Get access for free by scanning this QR code or clicking on the link in the description.
This is a typical risk graph on Thinkorswim. Just to orient you if you're not used to it, here's the 0 line. And what we're talking about today is how to trade a parabolic market using options. And there's a couple of ways to do it, but the main idea that we want to focus on is how to approach something so that your risk graph has this sort of V shape to it, opposite of what you would normally do. Normally, if you put on a butterfly, you want price to land in the sweet spot. You kind of don't want it to go anywhere. But with parabolic markets, it's already made a really big move, and outsized moves often revert with velocity. So we want to take advantage of that. Also, this isn't just like finding one name that went crazy. 35 to 40% of the market right now is in a parabolic state. So you've got more edge in trying to continue the play. But who wants to buy something when it's already 2 standard deviations outside of its normal range, right? It doesn't feel very good to buy something that's already run like a mad demon. On the other hand, if you put on a trade that does take advantage of that, you can play it both directions. You need something that can profit if we keep going up or if we revert back really fast. You just don't want anything that's going to continue to stay in the middle, right? Like your iron condor or your butterfly, because those are trades that say, I bet you don't go anywhere. And we want to put on a trade that says, yeah, just keep doing what you're doing and I'm going to make money on it. So there's your typical everyday like strangle or straddle. You just right click, go into strangle, throw it on here. But as you can see, it's really wide, right? This needs a lot of movement on either side. And the risk is really deep. So we're looking at $1,200 loss in this if the price doesn't move far enough. So the break even is really far away. You have to have a massive move before expiration for this to see profit. If you get a really fast move in just a small amount of time, then it would become profitable because the P&L line would be somewhere up in here before expiration. But these usually require a lot of capital. There's huge risk to it. And this isn't one of the trades that I really like to play. You can also add wings to that to turn it into like an inverse iron condor. And that's what we call like a gamma condor, right? Instead of selling to open an iron condor, you can buy to open an iron condor, which is weird. Most of us wouldn't trade an iron condor that we buy, but that is a way that you can play it because it's the same thing, right? With a regular iron, you want price to stay in the window. That's one that you sell to open. If you buy to open one, you want price to get the heck out of the window. So we can always do the strangle or the straddle. That's fine. That's not really an argument. And it is a viable play. The only issue is how far away those break-even lines are. You have to have price really move fast or move far in a grind to get far enough away to make that a play that you're willing to do. And they're just the capital requirements on them. This is $1,300. And I don't know about you, but I don't want to load up on 20 of those. That doesn't suit me. There's another trade that you can do, though, that gives you a little bit of an opportunity. And depending on where you build it and the structure of the build, it's a lot cheaper and it often offers a viable alternative. So here is your butterfly with a broken wing on it. Now, I built this a little ahead of where we are right now, and I'm using UAL for my example because I think it represents a parabolic market, right? There's a lot of things right now that look like this, and that's kind of what we're talking about. How the heck do you trade something that looks like this? Well, you don't want to short it. That's a bad idea. If it was just one name making a move like this, then possibly you could do the mean reversion, aggressive contrarian play. But when 35 to 40% of the market looks like this, you got to either decide to join or just get the heck out of the way. So we want something that can continue to make money to the upside, and something like this can do that. Now, if it overshoots the sweet spot, the highest point of profit, and it just keeps running to the upside, you still get profit in this. You're risking about 150 to make 100 in this one. I don't have it set perfectly. You can adjust the strikes some. You don't necessarily need to worry about putting one lower, although you could. If I move this entire structure, here's where price is now. If we move this peak and put it where price is, then the whole thing would shift and your loss would start somewhere down here. I don't like to do it that way. The cost of this thing would increase. It'd probably turn into a $300 trade That way you're risking 300 to make 200, and then it would have the tent right where price is now. That's not what we want to focus on. Price should not stay here. That's one of the key things you want to focus on in a parabolic play like this. It very likely won't run up and just stop there and digest. It's either going to continue to run until it gets to whatever peak when all of these markets start to top out, or it's going to reject here and it's going to fall back down really fast. That's the base case play. So you don't want to build any of these where the tent is sitting where we are right now. Project it higher or project it lower. So all I did here, instead of using a 90, 95, 100 butterfly, which would be your regular everyday equal distant butterfly, it would look like this, the typical butterfly that people see. We just scoot one side in, put all the risk that was on the upside down here onto the downside, and now we have this. So that's one side. This is for the calls. You can do the same thing. If you think we're going to fall and go back in the other direction, then you can put on a trade to the other side. Now, I used calls here to show that you can do the same trade to the downside. This is the same thing. I just took a butterfly, and instead of making it, what do we have at the top? 90, 95, 97, I just flipped which side was in and put it on the other side. So 90, 95, 97. Let's put this to 100 and put this to 92.5. Turn that back on. So now you can see if we fall from here, this trade will make money. If we run just a little bit higher, we'll get into the sweet spot. And if we overshoot it, then we start getting into risk. I'm not necessarily interested in playing this one, but if you think we're near that top out point and that we could go a little bit farther, but not a whole lot farther, this is a really good play for that. And you can set it higher. I have it at 100, but if you wanted to play it just a little bit more, thinking, yeah, we could get a little bit more, not a whole lot more, but maybe just a little bit more. Now you can see I've scooted it up even higher still. This one says price can continue to run higher all the way up to 103, has a sweet spot. Loss begins above 103, and anything below that will make some form of profit. So it doesn't have to continue to run. You'll still make $50, $47. It's not bad, right? It gives you an opportunity to play downside, play upside, and have a sweet spot and still keep the risk at a level that isn't $1,300. Right? So this is risking $200. Load up 10 or 12 of these things. It'd feel a lot better than trying to load up 10 or 12 that are $1,300 a piece. All of that was done with just the call side and adjusting the strikes. But we can do it another way too. We can take a butterfly and we can add a vertical into the butterfly. So a butterfly is typically 1, 2, 1. Now we've got 2, 3, 1. I pointed this one to the upside. Same thing. If we don't continue to rally and we fall back down, we're risking about $85. Just call it 100 for some easy talking. Risking 100 down here for a chance to make 150 up here. And again, just round. We can point that in the other direction too. So instead of having 2, 3, 1, we can flip that over and have 1, 3, 2. Same thing, just pointing it in the other direction. And we could scoot this tent peak higher to the upside like I did on that other one, just in case we rally a little bit more before we fall back down. But the thing is, if it falls immediately after you put this trade on, you're still going to make money. You're going to make $80. This is a way to play those parabolic moves where you're thinking, I don't know, it's kind of scary. It's already run so far. I don't want to be the sucker that buys it now and then it falls as soon as I get in. I get it, but that's where a trade like this comes into play. So one is called a broken wing butterfly. The other one is called a ratioed fly because we're changing the ratio of the butterfly from a 1-2-1 to a 3-2-1 or a 1-3-2. I've been using calls this whole time, but you can do it on the put side too. And if you think about the volatility that generally increases as a stock falls and how volatility can make the price of an option increase, it's likely that the puts would pay you better for the fall. I say that, but that's not a guarantee because a lot of these names have already increased their volatility because they've run too far too fast already, right? So the idea that a fall would increase the volatility even more probably won't pan out the way we would want to. But either way, you can do the trade on the put side, on the call side. You can do it on both sides. Some of these trades offer a net credit. You can spend that credit, put on a trade in the other direction, right? You're financing the other trade using the credit from the first trade. So this is the idea of using a broken wing butterfly or a ratioed fly to be able to play these parabolic moves, which will take advantage of the idea that if it's not done and it continues to run, you can make money. But if you do get in and it just crashes from there, so what? You're still making money. And it doesn't require a massive amount of capital or huge margin requirements, because those are prohibitive and restrictive to having a good trade. If you need a $200,000 margin to put on one lot, then it's just too big. And this trade will work on everything.
Join Club today to engage with Samantha and her team of 10 experts. Scan this QR code or click the link in the description. Subscribe to LaDuc Trading YouTube channel for more live trading room recap videos and other content.